Welcome to Objective 1 in Unit 4 of Property, Plant, and Equipment. In this first objective, we're going to look at the long-term assets of the company. Once a company is funded, it needs to deploy those funds into the investments in facilities and equipment to carry out its company mission. Restaurants need a well-equipped kitchen and an inviting dining area. Online retailers need a warehouse and a bank of servers. Bookstores need a stock of books and shelves. How do these long-term assets appear on the financial statements of a company? Our objective here is to be able to identify and value property, plant, and equipment. Long-term assets is the general term for resources that are held for an extended period of time, such as land, buildings, equipment, natural resources, and patents. These assets help produce revenues over many periods by facilitating the production and sale of goods or services to customers. In this objective, first, we'll study the tangible long-term assets that can be seen and touched, such as land, natural resources, buildings, and equipment. Let's take a look at the types of tangible assets. We often don't think of natural resources in this category, but long-term assets that are discovered or grown rather than constructed are called natural resources. These include things like oil, coal and minerals, and standing timber. The more common tangible assets we think about are plant assets or fixed assets. These include property or land, plant or buildings, equipment or machinery, vehicles, etc. When we value these items, we have to be careful to separate out costs from actual future economic benefits. Just because the company has paid out money to obtain something doesn't mean that that asset necessarily has future economic value to the business, so it may or may not be an asset. One example there are costs that benefit the current period only, and they are not considered assets. For example, the amounts that are paid for routine repairs on equipment don't actually increase the value of the equipment in the long term, and they are not part of the asset cost. Another example, we may have tangible items whose economic benefits have expired and thus are not assets. That is, we may have paid for a vehicle that now at this point in time no longer runs, and the disposal costs for it are greater than its disposal value. Whatever we have as a value on our books for this vehicle, we need to take off, because this is no longer an asset to us because it has no future economic benefit. Another example is we may have assets that are not in productive use. These have tangible form, they may have future economic value, have a valid fair value, but if we're not using them in our business, they're categorized either as a long-term or a short-term investment. For example, if we have land held for future use, we don't have a store built on it, we don't have a warehouse built on it, it's just land. That's called an investment. Or at the other end of the life of assets, we may have equipment that we are done using because we don't make that kind of product anymore. That equipment is held for disposal, and because we are not using it productively, it's going to get classified as an investment, probably short-term because we are actively trying to sell it. One more example. We could have assets for sale to customers that are categorized as inventory that look identical to fixed assets in our business. That is, if we were a computer company, we might have some computer equipment that's for sale to customers and some computer equipment that we ourselves are using in our business. The computer equipment that is used in the office, that's a fixed asset. The computer equipment, perhaps identical, that's available for sale to customers is classified as inventory. Now that we've identified what's going to count as a long-term fixed asset in our business, let's talk about valuation. The value of an asset is all of the costs of getting an asset ready for use in one's business. This is a much broader view than the specific amount that we buy to take possession of an asset. All assets, except land, goodwill, and indefinite-lived intangibles, once they're owned, are subsequently valued at their depreciated or amortized cost on the balance sheet and limited in value to their current recoverable cost or fair value. In other words, just because we have a value at the time of acquisition, that is not going to stay the value of the asset throughout its life. As the asset is used, its value is expected to decline, and we're going to be very careful never to have a value for an asset on our books that's more than its fair value. After acquisition, costs can expand or improve or extend the life of an asset. These are then considered incremental to the capitalized cost of those assets. So if we put a new engine in a car, that does expand the value of that car, and we will add it to the asset value of the car since it does extend its life. One caution as we record the value of an asset. If company stock is used to purchase a long-term asset, the more reliable measure of value is the fair value of the long-term asset, rather than saying that the value of the long-term asset is our attributed value of company stock. In that case, the consideration given, the equities, are valued at the fair value of the asset rather than determining an independent and subjective value for the equities and then applying that value to the long-term assets. Let's apply these valuation principles in specific cases. Remember that an asset is recorded at the fair value of what is given up or at the fair value of the asset received, whichever is more clearly evident. The value is going to include the actual cash paid at acquisition, the present value of future commitments to pay cash if we've bought it on account, the cash equivalent value of other assets that are traded, the cash equivalent value of any debt that's been forgiven in acquiring an asset, the cash equivalent value of equities issued if reliably valued, and the necessary costs required to arrange the purchase, to transport the asset, or to prepare the asset for use. For example, with land, some of the additional costs involved would be the costs of a land survey, legal fees, realtor commissions, transfer taxes, demolition costs of old structures, clearing, grading, or filling, special one-time assessments to provide infrastructure that will be managed by other parties, such as roads or sewage systems. All of those costs would be reduced by any recoveries from sale of features of the land, such as sale of timber that's cut down on the land, or salvage from the demolition. Note that under historical cost accounting, land is carried on the balance sheet at its original cost, even if the market value of the land is many times that of the original cost. However, declines in value must be recognized. Some international GAAP emphasize fair value and allow revaluations to higher values, but U.S. GAAP will only revalue assets to a lower value if their value is impaired and will not record increases in value. Land improvements are distinguished from land. When one buys land, there may be structures or fences or lights that are on that land, and those features are called land improvements. They need to be distinguished from the land because those land improvements are depreciable. They will not last forever. So when one acquires land that has structures or features on it, those are valued separately and recorded separately as assets on the books of the company. Let's talk about buildings and equipment now. Costs would include things such as sales tax, transportation costs, installation costs, costs of testing, or any necessary repairs or customization prior to use. As an example of this, think about installing additional memory into a computer before its use. That gets included as part of the cost of the asset. However, what if when you're taking the computer out, the monitor breaks, and we need to buy another monitor before we can begin to use that computer? Replacing the broken monitor is not part of the cost of the asset because it's not a necessary cost, and it does not enhance the computer's value to pay twice for a monitor. One complication in valuing assets is sometimes we have a purchase of an asset in which there's a single price given for a bundle of assets. We are not allowed in generally accepted accounting principles to have an account title for lump sum assets. Instead, we take the purchase price and we divide it up among all of the assets acquired. The acquisition cost is split among the assets relative to the sales value for those assets. Let's take a look at how we'll do that. Let's say we purchase a building and land together for $2 million. That's really the normal situation. Most companies own the land under the buildings that they own. But we need to separate out those two values because the building will need to be depreciated in the future and the land will not. We get an appraiser to estimate what the building is worth, and they give us $1,500,000. The land alone, if we just had the land, would be worth $1 million. Based on that information, we can now come up with the total value of that lump sum purchase had they been bought separately, which is $2,500,000. Now the relative value of the building is its separate value of $1,500,000 out of the total value $2,500,000, or 60%. The relative value of the land is its separate value of $1 million divided by the aggregate value of $2.5 million, or 40%. Based on those relative values, we'll then divide up the $2 million we actually paid and allocate $1,200,000 to the building and allocate 40% times $2 million, or $800,000, to the land. Here's one more complication to think about when acquiring assets. There are some assets that the company has a legal obligation to restore at the end of their use. Think about things like companies engaged in mining that are obligated to restore the surface area to a condition with at least the same potential use as it had when the mining began. That's a part of the cost of that asset from the moment that the company makes the purchase of that mine, and yet it's a future obligation that has not yet been spent. Required costs of disposal of an asset owned by a company is called a liability of asset retirement obligation. It's recorded at the time of the acquisition if it's estimable. The increase in the costs incurred to purchase an asset, even though the cost will incur in the future, is part of the value of that asset. the liability for asset retirement obligation is going to increase each period due to the time value of money, because we're going to get closer and closer to the point in time at which we're going to have to spend that money. You can think about it as a non-cash expense similar to interest expense. Let's take a look at an example and the journal entries involved. Let's say we have a company that's purchasing land with its mining rights in order to exploit the coal deposits. The cost of the land is $1 million, and the estimated cost to restore the land is $1 million to be paid in 20 years when the coal is fully recovered. The company investigates, and it could pre-fund the restoration in a contract with a restoration company for $150,000. That is, it could establish a contract, pay $150,000 now that will completely cover that future restoration. This means that the value of that restoration in present value terms is $150,000, and the future value is $1 million. Based on that information, we can solve for what the interest rate must be, such that we can settle a future obligation for $150,000 today. That's included in your time value of money chapter in your book, but you could also believe me that the value is 9.9501%, and there is a function in Excel that enables one to calculate that interest rate. Knowing that information now, the company can proceed to write the journal entry. At the time of the purchase, the natural resource has a value of both the cash paid for the mine and the rights to operate the mine, but it also is increased by that future amount that we'll need to pay of $150,000 called the asset retirement obligation. It's a payable that is a required liability that we incur when we purchase and use this natural resource. Then, each year, we're going to record how much larger that asset retirement obligation gets each period. We calculate it based on that interest rate. So at the end of the first year, the asset retirement obligation has increased by 9.9% times the $150,000, or $14,925. It is recognized on the books of the company as kind of a negative depreciation. The liability is getting larger, so we're going to have this additional expense every single year during the life of this mine, so that at the end of the period, at the end of the 20 years, the asset retirement obligation will be fully recognized at its $1 million level. These are all of the complications of recording, of identifying and valuing tangible long-term assets. In the next objective, we'll take a look at the other side of long-term assets, intangible assets. Thank you.